Julia from the U.S. Virgin Islands. Welcome, Julia. Welcome, welcome. Who else is here? We have a few other people, I know. You're coming into the room. If you could open the chat and direct it to all panelists and attendees. This is Be Strong Families webinar series, Staying Strong and Positive for Ourselves and Our Children. We are in our second year. I'm glad you love these Be Strong webinars, Julia. We love having you. And it's 12 o'clock, so we're going to get started. Today, we're delighted to have Ric Porrez back with us to talk about borrowing basics. It's our financial vitality and how do we get more money into our situation and how do we avoid getting that money into our situation, swamping us. So that Ric is here. And we're from Wintrust, and we love Wintrust. We love Ric, and we're really glad. Welcome, Ric.
Good morning, Kate.
Good morning. Good afternoon. I'm going to just buzz through these next two slides. Hi, Alfredo. Oh, Alfredo Romero for Ric Porrez. Oh, is Alfredo here too?
That's me, actually. Ric was not able to make it in today, so I will be, taking his place and do the presentation.
Oh, I'm sorry. I didn't track the difference. I thought you looked a little different, but I wasn't going to say anything. So maybe you should change your name on your change it to Alfredo Romero.
I put in the chat box my name and
I know, but you can change it on your on your photo, Yeah, there you go. Yes. That's great. That'll make so wonderful. Alfredo Wintrust, right? Ric's colleague.
That is correct.
Delighted to have you here.
Thank you. I'm glad to be here. Thank you for the opportunity.
And thank you. So just for everybody who's here in the group, we have two ways to engage. The first one is the chat, and you're welcome to use the chat anytime. Just to ask a question, to answer a question, to talk to each other, to say, wow, yes, I get it. And the other thing is if you have a question that you want to talk and you don't want to put it in the chat, you want to actually be heard, then just raise your hand. And then Andrew, who's in the background, Andrew Hitchcock is our tech support today. He will unmute you. You'll need to unmute yourself and then you'll be able to talk. So that is the scoop on our ways to engage. And whenever Be Strong Families does anything, we have agreements. These are in recognition that we co-create this safe space together. We're all here. So what do we agree to? We agree that we're going to speak from our own experience, that we're going to treat other people the way we want to be treated, and that we're going to dedicate this hour to this. So if you agree to these agreements, if you could write it in the chat, I agree. Awesome. Andrew agrees. Who else agrees? Need you to open it to all panelists and attendees. It's the second on the drop-down menu. And agree to the agreements. Yay, Siobhan, thank you for doing that. Let's see a couple. Amanda, great. Robin, fabulous. Awesome. Rebecca. Okay, good. We're on a roll. We can get started, and I will turn it over to Alfredo, and I'm going to stop my video because he's got it under control.
Thank you so much, Kathy. Thank you for that great introduction. I'm happy to be here. Thank you so much, everyone, for your time. And I'm going to try to make this as interesting and knowledgeable as possible. So today we're going to be discussing borrowing basics. Next slide, please. We're gonna skip these slides too. There's too many objectives, and we have a lot of things to cover. I feel it's more beneficial to jump through these things. This is a great slide to start out with. What is credit? Credit is the ability to borrow money. It is something that that can be used as a safety net. Something, well, not only as a safety net, but also that can help you save money in the long run. When you borrow credit or you borrow money from a bank, and you're not using any type of collateral or anything to secure the loan, you're pretty much, giving us your word that you're going to promise, to pay the money back with interest. Next slide, please. Why is credit important? Credit is extremely important nowadays because not only does it, help you in case of emergencies, but also nowadays, more and more employers are obtaining information from your credit report just to see what kind of pattern or how is it that what kind of spending habits you kind of have. So it will also, determine sometimes if you do get that job that you so much dream of getting. So it's important to be able to have a good credit report, be able to be responsible spending, because in the long run it will affect you in more than one way, not only just to obtain further credit down the line, but also to obtain, like I mentioned, that dream job that you might be looking for. Next slide, please. What is collateral? Collateral is something that you are going to be using, or you're going to be providing to the bank as security for money that we are going to be borrowing to you. So an example would be, let's say, if you have a home. A home is, something that we could use as collateral. Let's say if you're looking to do an extremely large loan, let's say for education purpose for your kids, and you don't have enough money to cover for their tuition. Well, this is a great way to obtain funds from your property, which you could use as collateral and obtain the funds that are needed at that time, and be able to get your kids through college, and hopefully within a short term you'll be able to pay those funds back, and you obtain two things: one, sending your kids to a great college, and the other thing, you keep your house as well. Next slide, please. Credit terms. Credit terms, let's see, so guarantee of fund collateral. Okay, so guarantee, when they refer to a guarantee, is once again, speaking about, what type of collateral is being used. Let's again use, the home, but then there's other options that are available. Nowadays, there's more than one piece of collateral that the banks, look for. Collateral could be a car title. It could be sometimes funds that are sitting in the bank account. Now, you might be asking, well, why would I ask for a loan if I have money in the bank? So that's a very good question. But to answer that question is, let's say if you are earning an extremely good rate on a CD, which if you break that CD, they're going to not only penalize you, but you're also going to lose that, that great rate that you're earning at the time. So that's one thing that you can also use as collateral. So there's other stuff as well. Let's see, unsecured loans. That's something that they don't require anything. Once again, it's just requiring you to pretty much saying that you promise to pay the money back within the agreed terms and conditions. Assets, something of value. Once again, everything from a home, a car, funds in the bank. That's all considered something of value. So that's stuff that you could use once again for collateral. Next slide, please. Credit cards. Credit cards could be something that's could be very dangerous if if they're used misappropriately. But then again, they could also be, very useful in more than one way. Not only will they will they serve as, let's say, as emergency funds if needed, but also keep in mind that nowadays a lot of the banks and credit card companies offer you more for your pockets. What's that? That one commercial, Capital One, that what's in your pocket. And so nowadays, not only is the credit card able to help you to give you extra funds when needed for emergency purposes, but also take advantage of any programs, any rewards programs that are available. Myself, I'll put myself as an example. I'm a big fan of credit cards. I think before this pandemic, I was getting 1 to 2 airline tickets a year, and I would take advantage of of that to go on vacation. My family of four with my wife and 2 kids, so that's definitely saving me money on 2 airline tickets. So that's more than one way to be able to take advantage of the credit cards. You just have to make sure you are spending responsibly, and you try not to use the maximum amount that they're letting you that your limit provides you, because that can actually create a negative impact on your credit report. And that's the last thing that that you want to do. That you're using these credit cards, you think that you're using them properly, but then you check your credit report. Your credit report started going down. You're asking why. Well, one of the reasons is being maxed out on those credit cards. So just be careful when you use the credit cards. Next slide, please. Home loans. Home loans. Excuse me. So home loans. This is the loans that we use primarily to purchase, a home. Nowadays, especially in this market right now, it's a seller's market. Why is it a seller's market? Because the rates are extremely low, and people are taking advantage of these historical low rates. Right now, I was just talking with my mortgage loan officer. Today's 15-year fixed rate loan is at 2.50, which is great. To have a rate that low is extremely good, because you're saving yourself a lot of money. I mean, and a lot has to do with of course you do have to meet your credit guidelines. So that goes into with what I mentioned earlier, taking care of your credit, because in the long run this might affect you from being able to get a 2.5 to maybe getting a 3.5 or 4.5. So it's important that you do take good care of your credit report. Another home loan that we do is to refinance. That's another thing that a lot of people are doing. This is for existing homeowners. So if they have an existing loan, let's say at a higher rate than what's being offered right now, they're taking advantage and refinancing, maybe lowering the rate or lowering the amount of time that that they have on their loan. Home equity loans. This would be considered a second mortgage, which is another lien on the property. So this would not touch your first loan. So this is based strictly on a second loan that's going to be a second lien on your property, which usually you have two options. One is a home equity loan, which is usually a fixed rate product, or a home equity line of credit. This one is more, it's variable and works very similar to a credit card, to where you use the funds, you're only paying interest for the amount for the amount that you are using at the time. Once you pay that back, you still have those funds available. So it's a really good product to have, especially if you're looking to do like home improvements, or you might have a small project in line. So this is a great product to help you achieve and make that dream come true. Before I continue, I want to see if there's any questions on the stuff that I covered, any concerns that I might be able to address right now. Let me just check the button. Okay, so I'm looking at more comments from Julia. So it says that you found that sometimes your credit score fluctuates, sometimes it's up and sometimes it drops. So that could be because you may be applying for several credit products. So whenever you apply for any credit product, let's say a credit card or a loan, that's considered a hard pull. So it will considerably drop your credit score. Another thing is also, how are you managing your loans, your credit cards? Are you on the high end on your credit cards? Are you pretty close to the limit? So some of the things just to look into, and try to maybe lower the amount that you owe. Another thing is just check your credit reports. Make sure that that everything that's on those credit reports is in fact yours, because nowadays, unfortunately, fraud has become very common, and you have to be very careful and monitor your credit report very closely. So every year you do have the option to obtain a copy of the credit reports. So this way, give you the option to see, everything that's on there. And further down the slides, we're going to give you that information on where you need to go. Let's see. I think a few more questions came up. Let's see. Let's see. From Tyria, forgive me if I butchered your name. Is it best to start with a secure credit card? Secure credit cards are a great product to start out your credits, or to help increase your credit score. So this the way it works is that you provide a secured a deposit. That deposit will be your credit limit. So within 12 months, they'll see how you monitored your credit score. At the end of 12 months, they'll release the deposit, and it will become a traditional credit card. But the most important thing that you want to do using these products is that you want to manage that credit card properly, where, let's say, if you get $500, that you're not carrying that $500 balance every from month to month, because instead of it helping you, it's not gonna help your credit scores increase. So I usually recommend at the most 50% of your available credit is what I would recommend using. If you're going to use 100%, just make sure to pay it off before statement cycle ends. This will avoid having that negative credit being reported within the following months. Let's see. We'll take this last question, and then we'll proceed from Amanda. So, what are the negatives refinancing your home? Mine is at 4.2, currently 2.5, I think. So, I don't see any negatives, because you will be dropping 2 points from your current rate. It is recommended to refinance your loan or your mortgage if it's at least 1% of a difference. In this situation, by you refinancing from your current rate to what's available right now, you are definitely going to be saving a lot more money. And you also have to see how many more years you have left, because let's say if you still owe 20 years and you're coming down to 15 years, well, not only are you saving 2 points, of the rate, but you're, cutting 5 years off, the term of your loan. So it's definitely, very beneficial. So I don't see any negative on that. So let's continue on to the next slide. Those are all great questions. This is one example that gives you, the how it works, when you want to take out a home equity product. So the way that we look at it is we look at the home value and then minus whatever your outstanding balance is on your first mortgage. So, and using this example, we have 50,000, built-in equity that you may be able to use. Now, with most of the banks, they go up to 80% of the loan to value. So in this situation, they're providing you that 50,000 would be available. But one thing to keep in mind or look into that if you're going above 80%, some banks might offer you going up to possibly 95% of the loan to value, but there's going to be an add-on on rates, and there might be some additional charges. So just, question that, whenever you're, trying to make, those type of loan products. Next slide, please. The cost of credits. So the cost of credits has to do with how much is it going to cost you to get, for us to, give you that money. And in some situations, let's say, I'll stay, with the home equity lines of credit. So usually with home equity lines of credit here with us, we will not charge you anything, no application fees, no closing costs, no appraisal fees. The only thing we do require is a 24-month commitment. So if you do close out or try to refinance that loan before, the fees that are going to be charged is pretty much what we paid for the the appraisal, the title fees. So we're looking maybe between $800 to $900, which we find only fair that we get back if you do not meet the 24-month commitment. If you stay the full 24 months and then you decide to close the product, you can definitely do that with no additional charges. So that's one of the fees that you gotta look into. Another one is annual fees. Usually with home equity lines of credit, you are looking at fees as well, annual fees. So as well as credit cards. Credit cards also you have to look at see if they have any annual fees. So be on the lookout for that. Interest, of course, is very important. You want to make sure that you are paying the least amount of interest, for the money that you are borrowing. With the case of credit cards, if you pay the amount that you charge, if you pay in full the amount that you use, for that statement cycle before your cycle cuts, you are avoiding, you don't have to pay any interest. So that's one way, save money, and also, probably take advantage, of any reward programs that, might be available. Next slide, please. Truth in lending disclosure. This is what the banks hand out to our clients. We are required to hand this out because this will disclose, any charges that the bank is charging you. So this will give you the option to see, what, like for example, Wintrust, will charge you to do a loan. Say, for example, if you feel that, the charges are too high, you could, do some shopping around, check, with other banks or lenders. They have to provide you with, this documents as well. So this way you'll be able to compare and see, how much, it's going to cost you from, to try to get this type of loan. Lenders must disclose the amount financed and a percentage rate, which is also APR, finance charges, and total payments. One of the recommendations that I always give my clients, this is probably the easiest. Look at how much the amount financed, in other words, the amount that you're getting, and look at the total payment, the total amount, of payments after, like the terms and, have been met, just, a simple math, subtract that. Let's say I'll do a simple example with, some of the cases that I've seen. So I've seen some customers come in, they go to these, like payday loan or, finance companies. They'll get a loan for $500, and their total amount of payments, once they comply, with the term, they're paying back $1,500 to $2,000. So just, be very careful, because that's a lot of money that you have to pay back just, for $500. So look at the rate, look at, any additional things that they might have added, any type of insurances. Some of, these finance companies are famous for adding insurance as to your loan, and not disclosing it. They try to, take advantage of, that moment that you're in need of funds. So just, be very careful. Like I said, it's just a simple math. Look at, what you're getting, and look at the total amount of payments. If like for $500, and if you're having to pay $1,500 back, that's extremely, high. So, just be careful with those. Next slide, please. Refund anticipation loans. So these were more and more popular before. They kind of, are going away, I believe, and it's probably because, the excess fees that, they're being charged. This is like, for example, for like tax refunds. A lot of people I know that, we wait, can't wait till we get our W-2s and, and go and get, file our taxes, and then, can't wait to get our refund. But sometimes, we find ourselves in a situation where we might, need that money right away. So some of these places have done what's called the anticipation loan, which they'll give you in other words, they would lend, they're going to lend you the money, but they're going to take a good amount of your refund to charge you. In this situation, they're doing, a refund of $1,500. Well, they're charging you $300 to give you the money up front. So I don't know about you guys, but $300 to me is a lot of money, and I think I'd rather wait a couple of weeks, especially if they're filing electronically. Usually, it takes 2 to 3 weeks. Hoping that there's no hiccups for you to get your money directly deposited into your bank account. In these type of situations is when the credit cards play a huge role. Like if you're finding yourself short on cash, just use your credit cards at the end once you get your refund, hopefully within a couple of weeks. Just go ahead and pay off the amount that is owed, and avoid having to pay any interest on it, and just save yourself that $300. Next slide, please. Okay, when you need money fast, so it is recommended for everyone to have a backup plan, or try to put some rainy day funds in the bank, because we never know when something's going to pop up, and you're going to be a little short on cash, and if you need that money right away, I mean, if there's no other resource, I mean, it's great to be able to have money in the bank. I encourage my customers to at least put in, I mean, as little as possible or as much as possible. That money does build up. I start them out, let's do $10. $10, a lot of people, could put away $10 a week, and that's the way that I get them started. At the end of the year, they do see the money accumulate, and it encourages them to even add more. So that's one of the ways to try to to borrow yourself money that way, but make sure that if you are going to take money from that emergency fund account, that once that you get back on your feet, that you put the money back and continue to save money, because you don't want to put yourself in a situation where you're not going to have any money down the road in case something else happens. Um, Another thing, compare loans between different banks and different finance companies. I know that for finance companies, the interest rates that they offer are ridiculously high. So compare them with your local bank. Usually, banks will have a much lower rate compared to what these finance companies are offering. Next slide, please. These are the things that the banks look into, and I'll go more into detail in the next following slides. So the four C's. First one, capacity, your ability to meet payments. Capital, value of your assets and net worth. Character, how you pay your bills or debts in the past. Collateral, once again, property assets used to secure the loan. Next slide, please. Capacity, how long have you been at your job? How much money do you make a month? What are your monthly expenses? So this is, what capacity is talking about. So we do look into, how much, when we pull the credit, we see how much debt you have, how, if you've been current on your payments, if you've been late on any payments, are you maxed out, on your credit card? So these are some of the things that we would look into as far as capacity. We also see like we require like current check stubs. That's where we see how much you are currently making an hour and or your salary, and if so, if you're still working your full-time hours. So this is one of the things that that plays a huge role within making a decision as when getting a loan. Next slide, please. Capital. How much money do you have in your checking accounts, savings accounts? Do you own your house? I know that that people sometimes say, why would I not want a loan if I have money in the bank account? Well, in some situations, people prefer to get a loan, especially let's use the example of a house loan right now. With the rates being extremely low, it is, sometimes, well, right now, it's actually better, to get a loan because the rates are so low that, you're going to be, paying so little for that huge amount of money that the bank is letting you use. So some people want to, they feel they have a better peace of mind, having the knowledge that they have, these funds in their bank accounts, and they're just relying, on their on the bank's, loan. So, if anything comes up, on unexpected expenses or, a pandemic like this, these people have money in their accounts, to help them, with any payments or, help, to feed them, dress them. I mean, until they get back on their feet. Next slide, please. Character. This, this is very important. This has to do once again with how you manage your credit. We analyze your credit reports. We see how you've been. Are you current on all your payments? Have you fallen behind? Have you filed for bankruptcy? Are there like any outstanding judgments? I mean, this is very important because let's say, for example, let's say, for example, one of your friends comes to borrow money from you, and you know that this friend has just lost his car because he's not making payments, but yes, this guy's partying every weekend. Just he's not disciplined at all. So how would you feel if you came across a person, a friend, a relative, this type of situation? I know for a fact that I've had, and I've turned them down just because I know exactly how what type of spending habits they have. And I mean, it's better for me to say no at this time than that I have to be looking for them to collect my money further down down the road. And of course, the person that borrowed the money, or the person who, like for example, in my case, I'm always going to be the bad one because I'm trying to collect, on something that is, mine. But these people don't see it that way. Next slide, please. Okay, so this actually provides you on where you're able to obtain your annual, a free copy of your credit report. You do have the option to get a free copy once a year. So it is highly recommended to obtain one copy every year. Look at everything that's on the report to make sure that it's accurate. Look at the inquiries. Inquiries are when somebody applies for credit, that creates an inquiry. So make sure that every inquiry that's popping up on your credit report is also yours. So if you have any questions, there's usually a number by that inquiry. Call them. Ask what that's related to, and just make sure that it belongs to you. Next slide, please. Predatory lending. This has to do with what I had mentioned earlier, reference to these finance companies that they charge you an arm and a leg, just for borrowing a small amount of money, and it's pretty expensive. Be very careful. I don't recommend them. I only recommend them if you have no other alternative. But just make sure that you review your documents very very closely. You don't want any added stuff on there like insurances. As far as the rate, unfortunately, with these finance companies, they're set with their rates, which are extremely high. We're looking at about maybe 30 to 40% or maybe higher. But at least make sure that these type of loans are not adding anything additional that's going to create that's going to make you pay more money than what you originally borrowed. Next slide, please. So this actually has the information for Ric Porrez, but I'm also going to type in my information on here. Let's see. Okay, so I put my contact information at the bottom. Let's continue on with the next slide.
That was the end of the presentation.
Okay, perfect.
Correct slides.
I'm looking at the chat box here and some of the comments that are made. For example, from Julia, use your credit card to pay your bills because you get the points. Great, great way, to properly manage, your credit card and get something in return, for your money. Let's see. Have found that cutting back on purchasing food, funding bills. Yep. Just try to avoid those late charges if you can. Don't wait. Do not wait until the due date. If you get paid every 2 weeks, try to pay at least a week in advance this is going to help you not only pay the loan quicker, but you're going to be saving yourself interest. So definitely good stuff. Are there any other questions that I might be able to answer at this time? I know we finished it a little earlier, which is, good. Last time I actually went over my hour.
We have a question from Norma who asked if you can provide this content in Spanish as well.
We do offer this presentation in Spanish too. With this, I'm going to have to refer over to Kathy or to one of the organizers because we can definitely do one of these presentations in Spanish as well.
Hi.
Looks like no
Wow,
more questions.
got really,
Oh,
got done really quickly. Oh, does
it's
switching
yeah,
your
just
credit card type impact your credit? I mean, I was listening. It's a lot of great information. Do people have any more questions about borrowing? Like, what are your experience, given all this that you've learned today, did it answer all your questions or do you have questions about borrowing? I mean, one of the things I was thinking of, Alfredo, when you were talking about like buying a house, I recently bought a house and like they wanted me to put money, a lot of money. They wanted me to put 20% down, okay, which would have been required me going into the sellers did, the bank didn't necessarily, but the sellers did, which would have required me to go into my retirement account and take out money. I'm old enough to do that without a penalty. But I was like, I'm making money on this money and the interest rate is so low on the loan. It doesn't make sense for me to borrow. Like, it doesn't make sense to me to put down more money than the minimum. And then I can use that extra money to not only you were talking about like have it in the bank in case of emergencies, but also to like do work on the house, decorate, So there's times when having not borrowing or borrowing more is actually better.
exactly. It gives you that peace of mind. It doesn't limit you as much. Because you have this loan which is backed up, by the bank, and you have your bank accounts, hopefully in a healthy situation. So you could continue to live the lifestyle that you have, and not have to worry about your house being taken away because your loan is spread out within hopefully 30 years, 15, 20 years, whatever.
Yeah, I wasn't talking about my house being taken away or anything like that. What I was talking about is like when I talked to the mortgage broker in the bank, I could borrow I could put 5% down and have a decent housing payment that I could still afford. And the seller wanted me to put more money down, but I was like, no, because I have other uses for that money. Similarly, I wanted you to explain something because you said that if you borrow up to the limit of your credit cards, your credit score won't be impacted if you pay it all off within the month. That was not true for my son. He just did that. Like he took a trip, he had like $1,000, $1,500, whatever credit limit. He took a trip to Florida. He used his credit card and he used it up to the limit. But he was planning on paying it back. We were going to reimburse him actually, but he was planning on paying it back before, the bill even hit. But meanwhile, Credit Karma, wrote him and said, your credit, his credit score went down like 30 points. And I explained to him that banks are, that the powers that be are looking, especially now with COVID, to see if somebody's getting into financial trouble. And one of the signs that they're getting into financial trouble is a change in the way they use their credit and specifically going up to the top end of their credit limit, But I told him, I think if you pay it off, it'll probably revert back to normal. But he said that hasn't been the case for him in the past. So I just wanted to ask you about that, a specific question.
Did he pay it off before the statement cycle cut?
Yeah.
And it still dropped him 34
It
points?
dropped him immediately after he used it. It just dropped him,
One of the things that I've seen with Credit Karma is that sometimes it's not very accurately, because I've seen that with our mortgage lender here. People come in and they say, well, I have 700 credits.
But that's different. I mean, I was going to interrupt you, but I asked that same question. Like my credit score for my mortgage was different from my credit score from Credit Karma. But my mortgage broker told me that's because for mortgages, there are different things that get taken into consideration. Credit Karma reports from Experian and TransUnion, which are the primary credit union. They're the primary credit monitors for normal, like, kinds of loans, not mortgages, like for car loans or for another credit card or whatever. like they don't, Credit Karma doesn't do anything other than Experian and TransUnion, you know. But, and that's the same thing that you're going to get if you go to mycreditreport.com or your free annual credit report. They're both doing from TransUnion and from Experian. But mortgage is different. But I guess what I'm saying is, like, do you know if like his credit is going to get restored because he does pay it off quickly, or is it going to take a long, time for the credit, monitors to become comfortable that he's not going down the tubes?
I think it's going to take a little bit of time for it to go back up. I just don't know why it dropped so much, seeing that he paid it off before the statement cut.
Yeah, I don't know either.
Sure, yeah, to be honest.
So Tyria's asking, is it true that there are two billing cycles, payment cycle and billing cycle? And does one impact the positive points more than the other?
With that one, I'm not going to be able to answer that one. That's actually, more towards, the credit card department. So with that one, I'm not going to, I usually, what I recommend is, just going off, the billing cycle. Yeah, as far as the payment cycle with that, I'm not familiar with it.
Yeah, what is a payment cycle different from a billing cycle? I mean, the billing cycle is when you get your bill, and the payment cycle is when the bill is due, like when you have to pay by, like after you get your bill,
Correct.
you have to pay by a certain date,
Correct. With
Can
the
you
payment,
talk a little bit, or I didn't hear you talking about like the problem with paying credit cards, just the minimum payment. Did you talk about that?
no, actually, I did not. So one of the things that you do not want to become very comfortable and pay the bare minimum of what the credit cards are asking, because usually the minimum is only interest. So you're never going to see that balance go down. So you want to make sure that you're applying a larger payment. And they're also, when you apply this minimum payment that's being reported, keep in mind everything that you pay, it's going to get reported to the credit bureau. So you want to be able to prove that you're able to make a larger payment. So when it comes to time for you to apply for anything else, this is going to show them that you do have that capacity.
Yeah, I think that's also true, that like if you just pay the minimum payment, then you're paying all this interest. The loan is never getting
It's never
less.
getting
And so you're basically just giving money to the bank. Like you're just continuing to give money to the bank instead of like reducing what you owe, right?
It's going to take you some time, and nowadays I've seen that with most credit cards, they give you an example on your statement where it says if you pay the minimum, it's going to take you X amount of years to pay it off, as opposed to paying a certain amount for a certain time frame. So it gives you an example, which is great, because it tells people exactly how the payments, or how long it's going to take them to pay it off.
Yeah, that was interesting when I just bought the house. It's my first house that I've really bought by myself, that they gave me also an amortization schedule, which is they showed me like when it would flip from paying more interest to paying more principal, because from the beginning you're paying, this is true on a car loan too. From the beginning, every time you pay your bill or your monthly loan amount, you're paying some amount of interest and some amount of principal, some amount of the original that you borrowed. But in the early stages, you're paying much more interest than you are paying off the actual loan. So one of the things that I was thinking about doing, especially actually money is so cheap right now that doesn't make sense. But when things are like high interest rates, then it's really crucial to get to the point where you are paying more the loan off, not so much interest. And to me, like I didn't know, but that by law, like a car loan and a mortgage loan, there's no prepayment penalty. So you can advance yourself in the amortization schedule by putting more money towards principal, like paying a little extra every month and telling the company this is for principal. This isn't, you have to tell them, because otherwise you'll just apply it to your next payment. But if you tell them this is to reduce principal, they have to do it, right?
That is so true. You have to make sure that, if you can, always, apply a little extra towards the principal, and this will help you not only save money in the long run, but you're going to be paying off your loan sooner than anticipated.
So one of my sons applied for a credit card, actually through Wintrust, and I guess he didn't qualify. I guess he maybe hadn't been employed long enough or something, but that you gave a different kind of credit. Like it was like, what's that called when you get, like there's a different kind of credit card. Like you can use it as a credit card, but he has to put money on it. It's different from a debit card.
Secured credit card?
Yeah. What's a secured credit card? Can you explain that to our listeners?
Certainly. So a secured credit card is intended to help you establish credits. So we take a deposit, usually with the credit cards that we offer. You could do as little as $300 and as much as $5,000. So whatever you provide us as a security deposit will be your credit limit. That credit card account will be monitored for 12 months. At the end of 12 months, they will determine how you manage your account, and will determine if they will release the deposit at that time and just make it a traditional credit card. It does have, once again, it's sometimes, a little expensive to be able to obtain credit at first. So it does have an annual fee of $35. But once the 12 months are up and you get your deposit back, they will make it a traditional credit card with no annual fee. And usually, if you establish credit for 6 months, you're going to begin to see a lot of offers, begin to roll in.
Right. So it wasn't really that he hadn't been employed. It was more that he didn't have any credit. Like that was true. A couple of people, they haven't, and that's true for some people, just, that they like paying for things in cash, or they think that they're living within their means by not using credit or not having credit. And I tried to explain to my son that it's a really good thing to borrow money. It's a really good thing to have a good credit rating, because if you never borrow money, you never get a good credit rating. Like they treat no credit as almost like bad credit. It's hard to get credit if you have no credit. So I was like, the most important thing is to get some credit and use it wisely so that you can have a good credit rating. Because as you were saying earlier in the presentation, that credit rating is important for all kinds of things. It's like not only getting a job, it's also like getting an apartment. Like a lot of apartment places where you're trying to rent, they require a certain credit limit to be able to even be considered for it. If you have bad credit, you can't live there, even if you can afford it. Even if you've always paid your rent on time, they don't care.
It's
right?
Very true. It's very true. I've come across a lot of customers that they're set in their ways, and they're used to just cash. Well, when they come in and applying, especially when the housing market crashed and a lot of properties were being sold so cheap, these people were coming and trying to get a loan. Well, they were being rejected because they have no credit history. They pay for everything in cash, and unfortunately, that took them away, from taking advantage, of these opportunities. So something to think about. And a lot of the responses that I get is that they say, "Well, you guys just want me to get into debt, so you guys could charge me, all this ridiculous interest." No. I'm not saying that. I'm just saying you have to, be disciplined and, manage, your credits properly. There's ways that you can save, money.
Yeah, I mean, and that's the thing is like, it's like a pay to play system. Like you need, if you want to be, if you want to be able to borrow money for a house or a car or anything, you have to start establishing a credit limit and a credit rating. And if you pay for everything in cash, you don't do that, you know? So even though you think you're being responsible and you think you're being, you know, like, check it out, like, and show you my tax returns. I make a lot of money. You know, look what I've done. Still, it doesn't make a difference to the bank. They want to see that you have borrowed money and you've paid it back, like that you've borrowed money and you've paid it back, because that makes you a better credit risk. And Julia is saying something which I think is also true, and just Alfredo, you can confirm it. Like you have to keep your credit card balance under, like you have, like say I have $5,000 credit limit through all of my credit cards. I have to keep it at, I can only borrow like 1,000 or 2,000, like up to 30% in order to keep my credit rating high. When I start going, that's what I was telling you about my son, Julia, like if you start going up to the limit, and especially if you stay at the limit, your credit rating will suffer. So one of the things I did, you know, because I had a good job and I had a salary coming in, is like, first of all, I was like, I'm only going to have one credit card. But then I was using too much of my credit, you know, to be able to keep my credit rating good. So I just got 3 more credit cards, and I don't necessarily use them, but I got them. So my credit limit increased. And so the percentage of credit I was using decreased, and that helped my credit rating.
It is correct what, you know, Julia mentioned, you know, going up, using, you know, a third. Just, you know, my recommendation, if you find yourself, you know, extremely tight on funds, you know, 50% at the max, but if you could do a third, that's where you need to be.
Yeah, and I think the thing is, like, for kids especially, and this was like something that I thought was really important, because I didn't know when I was a kid. So when I was teaching my sons, it was like, you know, it's not free money. A credit card is not free money. You're gonna, and how am I going to say, like, don't, if you can't afford it, like you shouldn't be buying it. Like you don't buy things on credit that you can't afford, that you have not figured out how you're going to pay for in the long run, because otherwise that's the recipe for disaster. That's when you know, get your, even if you can get more credit cards and people will give you more credit cards, if you just get, that's how you get yourself in serious debt. Like you were talking about people saying, like, you just want me to get into serious debt. Well, actually, banks don't want you to get into serious debt, because then they're less likely to get paid back, you know, so they don't want you to be in serious debt, but they want you to manage your money responsibly, so that they can have faith that you're going to manage the money they give you responsibly. So
That's true. The credit reports that we see are references, pretty much, you know, that the banks use to be able to determine if we could, you know, if we're gonna get our money back, right? So
yep.
that's one good way.
So thank you, Alfredo. I'm getting a message that we're almost out of time, so I'm just going to power through the last couple of slides. Thank you for being here. We're here every day. Tomorrow, Samantha Moore Valentine. Thursday, Alexandra and I are holding space for an interesting conversation on when is it race and when is it something else. And Samantha Peterson is going to be talking about writing for scholarships. It's a different title than was on the publicity, because her co-presenter is in the hospital now. So pray for him. And then I want to tell you what's coming up next week. Is we are starting a vitality journey for April and May. And this is like, just because we think it's the time for all of us to work on our holistic vitality and really look at holistic vitality as a foundation for strong families and communities. So if you would like to join us, we would appreciate it. We would love it. We're going to use the webinars as a check-in opportunity, just to kind of build support and accountability. So if you want friends who are also on this journey with you, just keep coming to the webinars, and we'll have occasional guest presenters, but most of the time it'll be one of us, one of the Be Strong Families staff holding space. And we'll have a topic and it's micro training, like some information, 2 slides, mostly conversation on how's it going. So we encourage you to join us, make your own vitality journey, get your mask, keep wearing your mask, get one from us. And thank you very much for being here.
Thank you, everyone. Thank you, Kathy.
Thank you, Alfredo. It was wonderful to be with you. Thanks for pitching in for Rick, pinch hitting for Rick.
Take care, everyone. Have a great day.
Take care. Bye-bye.